All right, let's get started. Some technical. This is risk management. Y'all look familiar. So kind of a small class for this many people, but so risk management. I'm Ron Sweet. Somewhere in here. So I teach 8 classes at UTSA over 2 semesters, and this is by far my favorite one. It may not be your favorite if you've taken all my classes, but it's my favorite. I love this topic. It's an unusual class, but it's my favorite. I don't teach it like a traditional risk management. A lot of courses, a lot of colleges, risk management is part of the financial planning and the wealth management side. I teach it as a finance class, not as a wealth management class. If we have a wealth management degree plan, eventually they'll probably have to shift this class. I teach it as a financial risk management class. So investors, portfolio managers, corporate finance people, not wealth management. So we'll do a little wealth management. The last project's somewhat like that, but I'm doing it from the standpoint of a finance professional, not a CFP. I've been at UTSA for I don't know how long, close to 30 years. So been here quite a while. So let's talk a little on the class, just walk through the syllabus, and then I want to help you get started on the first paper so you can get ahead of the game. So we have 2 exams. My exams will have some pretty challenging essay questions and then some very straightforward math questions. The math questions, I have a lot of YouTubes to help you, and we walk through them. I think they're really powerful math problems because they're very real life things you do in real life in an actual job at a bank or insurance company or pension plan. So 2 of those, you'll know what's on the exam in advance, so you don't have to worry about that. And I've had the essays in the past have been open book. I used to do them not open book, and then with COVID, I went to open book, thinking, wow, the grades are going to really go up, and they didn't change at all. They're exactly the same as before. So I don't understand that. So as we get into exams, you'll see what those essays are. The paper 1 is the toughest part of the class. Some students really struggle on it. We'll go through it tonight. I did lessen it. It's not quite as tough as it was two years ago. So last year I changed it. So it's not as much work. So I'm expecting more depth in what you're going to work on. I think you're going to like it better this way because you'll see when we go through it. Class participation and attendance. So on attendance, read my attendance policy. Had a professor say, I don't do attendance, I'm not their mother. I think she completely missed the secret and magic of taking attendance. So why do I take attendance? Some of y'all know why, but I don't take attendance because I'm trying to dictate, micromanage your life. I take attendance because I have a reputation for taking attendance, which means unengaged students don't sign up for my class. And I'm very happy that unengaged students don't take my class. It actually makes me very happy. I only want engaged students. I don't want students that are going through the motion. There's students, you've seen them, they're going to graduate knowing as little as possible, and they think that's an accomplishment. Great, more power to them. That's not my kind of student. I want students that want to change the world in finance and radically, take on a job and just radically change everything. So that's the reason I take attendance. But the second reason is it helps me learn your names. So if you ace this class, boy, I'll fight really hard to help you get a job, be a reference for you, give you contacts when jobs come to me. So I'm frequently sending job opportunities to people all the time. I still get them as old as I am now. I've been retired for 13 years now. I still have great access to industry people. Victory Capital comes to us constantly for hiring their interns, Goldman Sachs, Citibank. I get several emails. So ace the class and boy, I'll fight for you, but I can't do that if I don't know who you are. If I just look at your grade and never can't remember your face. So come to class. If you're not the kind of person who comes to class, and simple, just drop this class and go take another one. Maybe we won't be doing this in 5 years from now. The world's changing. I know AI is changing. Might put colleges out of business. So I'll retire and go do something else, move to Costa Rica. But I love this. I love the community of the classroom, of learning. It's extremely important for your networking, to get to know each other, to interact, to ask questions. I just think it's a far superior approach, but I know the world's changing, but I'm an old fogey, so I'm going to stick with it because that's what we have right now. And the instructor survey, you get 1 point added to your grade, 1% added. So what should you focus on right now? You can't do anything on the exams because we're going to cover those in the lectures. The risk project's a really good project. It's not that difficult. It's a little long, but you're going to be doing really, really real life stuff, but there's no reason to even think about that. So right now, really your whole focus on this class is on this first paper. You should start on it yesterday. So you're already behind, a little stress. So get on it pretty quickly. I'll talk tonight what you can do to start working on it. It's been a powerful, I've had a few students get jobs because they did this paper. So it's a powerful paper. It's really quite helpful. Especially if you interview with the firm that you do your paper on. As far as communication, I have office hours. I'm not sure exactly what they're going to be. I'm in the FSC on the first floor Monday through Thursdays in the afternoons. You usually find me in there unless I'm in class. But I am in the investment society. We have the president of the investment society in here, Anna, and we'll give you more information on that if you want to participate. But we do a lot of activities, so I'm in those activities throughout the week. But you can contact me anytime. You can call. You want to call me at 8 a.m. I'm on a bike. That's fine. I can talk when I'm on a bike. So anytime you want to call me, talk about the class, talk about careers, whatever, talk about finance. I had one student in this class who'd call me at 10 p.m. to talk about oil prices. And we'll be on the phone for 2 hours. Like, I've got to be at work tomorrow at 7 a.m. But if you want to talk oil prices, I'll talk. So call me anytime. If you text me, I might reply, but if I get your text when I'm on the phone, when I come home, I'll forget that you texted me because I'm not really good at keeping text. So you're better off emailing me. But anytime you want to talk or have questions, that's perfectly fine. Some students freak out on papers and especially the essays on the exam because I am real picky, not picky as far as details. I'm picky as far as depth. I don't like high level kind of squirrely answers. I want you to really get into the meat of the question. So if you're worried about that, come to me before it's due and show me your paper, and I'll at least make sure you don't have a disaster. I won't sit there and get you to like an A+, but at least make sure there's not something major missing. So the class itself, we'll do an overview tonight. Let's talk quite a bit about paper 1. And then the risk management process is part of what you're going to do in paper 1. So we need to get through that. Give you some perspective on risk, where we've come. I'll use a particular book by Peter Bernstein on that. And then I'm using I forget the group of 7 or whatever. I forget the name of the group, but they have a list of risks that they use. I'm using their list. It's very finance focused, so it's a really good list. And we're going to start with my favorite risk of all, which is interest rate risk. So we're going to spend quite a bit of time on that. My whole career was balance sheet immunization. So we're going to have how many of y'all have heard of balance sheet immunization in here? No one's yet. All right. So it's a really cool area. Any actuarial majors in here? All right. So at least if you work for a life insurance company, that's what they do, is balance sheet immunization. I love it. It's a great topic, mainly because it's extremely complicated, but it has solutions. So if you walk in, I love that. You take, like with USAA, we have these problems where it's just like, man, this is so complex. You work on it, say, hey, wait, we got a solution. This actually works. We will be better if we do this. I love that. You can't do that in all areas of finance. So we're going to keep it somewhat simple here. Like life insurance is probably the most complicated there is. We're going to talk life insurance pretty high level, but we'll start with banks where it's the easiest. And then we'll talk about pension plans, and one of your essay questions is going to be on pension plans because it gets more complicated, and then it's most complicated with life insurance. And then I'll try to tie it back to your own personal life because you have interest rate risk and you need to manage that. So we'll spend some time there, talk liquidity, then spend quite a bit of time on market risk, which is where you're going to do your paper 1. It's going to be on market risk. And we'll talk more about it as we can. We'll see how I'm going to do these 2 days. I haven't decided quite yet. Then credit risk. Project 1 used to include credit risk, but I took it out mainly because when you're assessing these banks, credit risk is it's 30, 40 pages. It's just too much. It's a little frustrating to do that every bank is just overwhelming. So we'll talk credit risk, we'll talk about your banks, but I won't make you write about it. And then we'll have a bunch of other risk. And then we're going to talk really my favorite part. So most of you are seniors, probably about to graduate. You've gotten all this textbook stuff. So now we're going to ask, does it actually work? We're going to see what some of these leaders, you've probably heard of some of them. Nassim Taleb, y'all heard of him, Black Swan, a little bit of randomness. You've all heard of Kahneman, pretty famous person there. I love Doug Hubbard's, what he does. We're going to do some Doug Hubbard. But what people are thinking about risk management that might radically change what you learn in your class. This is probably the single most important thing you do in finance and as an actuary is thinking about risk. How do you measure it? How do you manage it? How do you mitigate it? Extremely important. And then we'll finish up with some case studies. I'm working on one case study right now with some UTSA alums. After what happened in 2020, and even right now with the what's going on with Russia and Ukraine, is supply chain management risk. I think is a really, really important one. So I'm trying to get a supply chain manager from HEB and talk about what HEB went through when they couldn't sell any toilet paper or milk, or was it milk? Yeah, right. Wasn't it milk? I mean, I remember going to HEB that had no milk. So next time I went and I got 2 milks and they said, you only have 1. I said, yeah, but last time I couldn't get 1 and they didn't buy it. They didn't let me get my 2. And then another one is a trucker. If I can get him, his supply chain management issue is drivers. They can't get enough drivers. So just talking through some of these risks. I've done other ones. One I did was United. Y'all remember when United dragged, the guy got dragged off the plane maybe a while ago. I could probably do Southwest, couldn't I? Wouldn't that be an interesting risk? So we'll find one that's an operational risk and just say what went wrong. What I'd love to do, if I can't get that, I've been trying to get the Federal Aviation Agency and how they handle plane crashes, which I think is one of the best risk management processes. But something like that as one of our case studies, and then the other ones are ones I've done historically, which I really like as well. So that's the class. The first half or 2/3 is going risk by risk by risk. You're going to see when we get into the process, bottom line, the process is define, measure, mitigate. That's the class. Define what is interest rate risk. How do you measure interest rate risk? How do you mitigate? That's your paper 1. On paper 1, you're going to do market risk. You're going to say, how does this bank define it? How do they measure it? And how do they mitigate? Okay, so you've seen kind of how paper 1's going to work. Right. Paper 1's not due until March after exam 1. So what does that mean? There's 2 types of students. The student starts on paper 1 right there, and I get a horrible paper and they don't do well. And the student starts on paper 1 right here. So what kind of student are you? I'm the excessive compulsive that starts the first day of class. That's just the way I was. I've never understood the advantage of procrastination. I don't know what value it has. So I'm not a procrastinator, but you can't be a procrastinator in finance because finance is an extremely autonomous job. There's no one telling you what to do for 3, 4, 5. You can go 2 months and no one talk to you. You better have done something in those 2 months. You have to be a self-initiator. When I was an accounting major, there were people telling me what to do every second of the day. And then I went to finance and my boss said, do your job, see you later. It's like, well, what's my job? Well, read your job description. My job description said, make USAA better. I said, okay, that's kind of open-ended. So you've got to find some way to discipline yourself. And this is a good project to do that. Right in my security analysis class, same as you, right? You got to somehow figure out how to coordinate that. So that's going to be really important. It's too hard of a paper to leave it to the last second. Questions on the syllabus? Everybody's good. So let's talk some paper 1. Let me bring in the paper description so you can see it. So there's a file on Blackboard. It says files for papers, and there's paper 1 description. So this is an application. We're going to talk about this stuff in class, but you can start paper before you actually get to market risk. So you don't need to wait until market risk. You notice we're starting with interest rate risk. So keep in mind, interest rate risk is a special case of market risk. So interest rate risk and market risk are really part of the same thing. So market risk is the high level and interest rate risk is a special case. So you'll really be talking about interest rate risk. So what I want you to do is apply what we did to an actual real life case. So you're going to do an assessment of a bank's overall risk management and price risk, market risk, interest rate risk, liquidity risk. It depends on what they call it. They call it all different things. It's those kind of things where the market price of something moves. So what happens to bond prices when interest rates rise? Bond prices, they fall. Interest rate rise, that's a price risk, isn't it? Interest rates rise, bond prices fall, that's a price risk. What do stock valuations do when stock prices fall? That one's pretty straightforward, isn't it? Pretty obvious. Liquidity risk, we'll talk about that one, but liquidity risk is you need cash, you got to sell something fast, and trying to sell something fast, that causes the price to fall. All right, I'm not talking about selling stocks. Stocks are very liquid, aren't they? You can sell a stock really fast, and me selling a stock is not going to cause the stock price to go down. But if I own the, I always say the Sears Tower in Chicago, it's not that anymore. I forget the name of it. But if I need cash next week to pay my college tuition, the only thing I own is the Sears Tower, I'm probably not going to get a good price for the Sears Tower if I have to sell it in a week. That's liquidity risk. My trying to sell something causes its price to come down. Equity risk is stock risk, also includes real estate and obviously currencies and commodities. So something that can fall in value. So if we're looking at, the other thing you have to realize is price risk also includes the liability side of the balance sheet. So when interest rates fall or rise, banks and insurance companies, liabilities can go up and down. So you have to watch those two. We'll talk about that. That's what balance sheet immunization is. So what you need to do right now is select your bank. All right. I'm not going to dictate to you which one you use, but let me give you some examples. The most popular ones in the past. So Goldman, Sachs, obviously, Morgan Stanley. Oh, I can't remember. Is there an E in there somewhere? Obviously, JP Morgan, Bank of America, Citibank, Wells Fargo. Those are the primary ones people pick. Can y'all think of some others?
Would Red Oak Group be too local?
Yeah, I wouldn't do a credit union. I wouldn't do USA. You need someone that's publicly traded because you're going to need their annual report.
Oh,
No, you need a bank. BlackRock is an investment firm. It's very, very different.
National Bank, small national bank.
What's the name of it?
Small national bank.
Yeah. If it's a small bank, if it's publicly traded, you can try, but you're going to find like some people. Right, but you can look. Some students have wanted to do Frost Bank, and Frost, you want several pages, and when you go to Frost, it's like a few paragraphs. There's just not much meat there, so it's tough to do. USAA does all of this, but they don't write it up about it in their annual report. The annual report is so thin, so Frost doesn't work. So I think you're going to need a fairly significant size bank. PNC might be large enough. I know a student did PNC before, and they were a little frustrated. It was just not enough data. So you're better off with the big companies. The larger, the better. Wells is interesting, obviously, because they've had some huge blowups. Goldman Sachs, JP Morgan had the well incident. Goldman Sachs has had their issue overseas, and Goldman Sachs today somewhat blew up. Morgan Stanley was up 6%. Goldman was down 6%. What's going on with them? So pick one. Let me know which one you're going to do. I'm going to actually put it when we do attendance. I'll put your bank next to it. I actually grade them by bank. So I do all the Goldman together so that I know what's in there. Now, which annual report you're going to use? You're probably going to have to do the 2021 report because the 2022 won't be out probably until February, March. It's going to be too late. However, I really strongly recommend that you go back, and I'll show you some quick tables you can look at. 2020 was a huge event. We had things happen in 2020 which statistically were impossible. They were like 10, 11 sigma events. And so what you'll notice if you compare 2019 to 2020 is some fairly significant changes in what the bank wrote about. It was a huge shock. So I'm not so sure 2022 is going to be that much radically different than 2021, except for 2022 was the whole inflationary issue, the strong US dollar, commodity prices. There were some things going on in 20, but not nearly as big as 2020. So you might want to compare 2019, 20, not the whole thing, but compare certain tables, especially on value at risk. So if I were you, I would go get their annual report, find the risk management section and copy and paste the entire thing into a Word document so you can start editing and organizing it. So let me show you Goldman Sachs. So Goldman Sachs, you just type in Google Goldman Sachs annual report, and the 2021 comes up. And then on them, on page 116, there's a whole section on market risk management, which is what we're after. You can see it goes on for quite some time, which means there's a whole section on risk management somewhere. There's liquidity. Liquidity risk management. And here's the overall structure. You'll see charts like this. So there it is, overview and structure risk management. Every bank will have it slightly different than that. The way I find it is I usually do a search on VAR space. If you do that, you'll find value at risk. Well, what is value at risk? Anybody know value at risk? Is it define, measure, or mitigate? What would you think? Does VAR define risk? Does it measure your risk, or does it help reduce your risk? It's a measurement. So value risk is probably the most common risk measure for price risk. Hedge funds use it, banks use it, insurance, USAA uses it. They don't call it value at risk, they call it probable maximum loss, but it's the same type of concept. What about stress testing? Is that a measurement or is that a mitigation? Y'all heard of stress tests, haven't you? After the 2008 crisis, banks have to do stress tests. Does that sound like you're measuring something or you're reducing a risk? That's a measurement, right? It's a pretty common one. Look how much they talk about these. And then they give you tables. There's Goldman Sachs value at risk right there. Interest rate risk, equity risk, currencies, commodity, and then we'll talk about the diversification. Then they have limits. The limit says you can't have more than 80 million of this. That's not like a measurement or a mitigation. It's a mitigation. Limits or mitigation. So that's part of what you're going to do in this is how does Goldman Sachs define market risk? Well, if we go back to market risk, this one's pretty easy. Market risk is the risk of loss in the value of our inventory, investments, loans, and other financial assets and liabilities. See, it's both. Accounted for at fair value due to changes in market conditions. That's pretty easy. So what do? You quote that. And then you say, in reading more of this section, what I think they're saying is this. What does it include? What doesn't include? You get a little bit more insight into it. But there's the definition right there. Now, we're not doing credit risk. The definition of credit risk is very, very interesting to me because some banks define credit risk as the risk of default. Someone actually misses a payment. Some banks define credit risk as risk of default and risk of downgrade. That a firm they're loaning to was triple B, now they're double B, spreads gap out. Some firms, default risk is on a credit risk, but downgrade risk goes on their price risk. So that's always becoming interesting. Where do they have downgrade risk? So banks are not all exactly the same. And I'm going to tell you the general things you're going to see. Obviously, here we're in credit risk because you've seen all these ratings. All right. So find that risk management section and start reading it. But read it, I would say, in words. You can highlight it and see. Maybe you read it through once real quickly in the original form, and then get it in the place where you can start editing. What you want to do is start putting stuff under define, measure, mitigate, under measure, what do they measure? Value at risk, stress testing. There's other things you're going to see, economic net worth, economic earnings. There's other things they're going to talk about, and then mitigation, correlation, diversification, limits. You're going to look at those kind of things. You're going to see some others, netting arrangements, master netting arrangements. There's things you're going to see all these banks are going to do, which is one reason I don't like doing PNC and Frost, because they don't do all of those things. Probably one of the biggest mitigations that these banks do is derivatives, interest rate derivatives, credit derivatives. Credit for derivatives probably going on credit risk, but derivatives is a big part of it. So you want to make sure you have that in there. So that's one thing, one reason I grade, Goldman Sachs all together. 4 students talk about how Goldman Sachs uses derivatives to mitigate risk, and then the 5th student doesn't even mention derivatives. And I know, okay, there's a problem. And I know all these banks use derivatives. At USAA, we use derivatives. Any major institution is. And are y'all familiar with interest rate swaps? I think Catapacum does them. So we're going to do some interest rate swaps in here. I probably do it a little differently than other classes. So you'll see, I do stuff from a practitioner standpoint. So how we actually did it in practice. And then when I get to textbook and I don't know what they're talking about. That's not the way we did it. So it's confusing to me. So you need to learn both ways, but all right. Then what you're going to do is you're going to summarize their overall philosophy, which can be several pages. That's where you're going to have the committee. And so this is pretty critical that you get into this. So the who of this. So obviously you got management, you got committees. What I think is interesting is the board. You always have the audit, which I think is interesting. Audit is who is audit? What was their degree in college? Accounting. What do accountants know about finance and interest rate risk? Well, if they work for a bank, they know quite a bit. This is a big part of their job, but it is written by accountants. And I mean, the annual report's written by accountants, and the audit committee is accountants managing something that is just pure finance, real complex. So obviously they're specialized in that area. And you may have some key players, some tech, but who's involved. So management's ultimately responsible. So when JP Morgan had that well risk blow up, you got the CEO of JP Morgan saying very surprisingly, wow, I never saw that coming. I didn't know about that. That's kind of scary. The CEO of a company that large, wow, I didn't see that coming at all. So it's obviously Diamond's a really smart person. He knows his bank extremely well. And I'm going to show you at the end what you're going to need to do to talk about some of these banks. Are they too big? Are they too complex to really manage? These are huge, huge entities. Then you're going to say the how. So here's the committees again. And I think this is going to probably be your most frustrating part. And I think it's because there's some I don't know, I think of the word blowing smoke or something. There's some, some of these banks, JP Morgan and Goldman Sachs, I challenge you to read the 10 different committees and figure out what they're doing that's different. You got these 6 committees, man, it sure sounds like they're all doing the same thing. So try to figure it out. I'll show you when you get to JP Morgan. It's really confusing. And so is it clear? So I'll tell you how we did it at USAA. I can't spell responsibility, so Bill Gates can. Yep. So at USAA, it was pretty cool. We had a committee. It's called the Corporate Asset Liability Management Committee. Corporate Asset Liability Management Committee. It was called the CALM. I thought that was really appropriate for a risk committee. When we started it, 7 people showed up. No one cared. We met quarterly. And then USAA hired a new CEO, Bob Davis. We told him about the call. He says, well, I'm going to start attending all those meetings. Well, guess how many people started attending the call? We had 50 people in the room. He attended every single meeting. We went through liquidity risk, price risk, interest rate risk, currency risk. We went through all of these things. And he was responsible for everything. He was a lot like AIG. We might mention AIG. AIG, when Greenberg was there, Greenberg was responsible for everything. Some people say that's micromanaging. But what happened to AIG when Greenberg left? It went insolvent. Does it have anything to do with it? You can talk to John Toohey. Some of you are taking John Toohey's. So ask John Toohey, was Greenberg's leaving AIG have any impact on AIG going under, and see what he says. It's funny when John Toohey took my place at USA when I retired, and when he interviewed with us, he goes, yeah, I worked at AIG and I know it wasn't my fault. He had to say that. That's kind of a problem of working at a firm like that, a major firm that goes under, you're tainted for the rest of your life. Every time you say you work for AIG, you have to say, but I wasn't in that department. So these are huge, huge risks. So AIG went from a structure very similar to USA. One person's just micromanaging everything, to him leaving and then the firm going under. So USA CEO said, I'm going to look at everything. And so it was real clear at USA. Who's responsible for liquidity risk? The COM. What about interest rate risk? The COM. You're not going to find that at Goldman and JP Morgan. There's all of these different committees. I think it's frustrating. Let's look at it since I'm talking about it. Oh, that finally came up. So you find the committee structure. They all look very similar to this. Does that look complicated to you? I think JP Morgan's might be the most complicated. So there's a board of directors, and then the committees, the board has their own committees. So the board has an audit committee. Then you have senior management, so the chief executive officer. This is one thing you definitely want to look at. Does this firm have a chief risk officer? I think almost all of these firms do now. They didn't 20 years ago. Before 2008, most of them did not. USA hired a chief risk officer right after 2009. There it is over here, chief risk. And notice that he or she's way over here to the side. Why is that? Why is the chief risk officer sitting over? Look where audit is. You might have an idea why audit and the CRO are sitting off way no man's land. Guesses on that? What are they trying to express here? Group thinking, that I mean part of it. What else might be going on here? Starts with an I. Responsibilities, but what are they? I mean, it is responsibility, but specifically what? Starts with an I. You're trying to show independence. You don't want the internal audit answering to the CEO, and the CEO says, oh no, that's really not a risk. We don't need to report that. No. You want the auditor, if they see something, they need to go to the board and say, hey, this is a problem. They need to be able to go around the CEO. Now the question is, can they actually do that? Same thing on the chief risk officer. Read carefully on the chief risk officer. Does he or she have the ability to go around the CEO and go straight to the board and complain about something that's going on? Now, I think at USA, I'm going to say this on film. I'm not sure the video is working right now, but I do Zoom all my classes and they will be on YouTube afterwards, but I'm not sure the microphone's working on this one. I actually had lunch with the lady they hired because I was trying to give her all my background. I had some strong opinions and I was retiring, so I didn't care. They couldn't do anything to me at that point. But I don't think they gave her the power. So I think some firms, this is what I want to look at. I think USA might have had this problem. Let's hire a CRO, a chief risk officer, so we can say we have one, but it's not really give her any power. This is kind of, a figurehead. And I don't think this lady wanted to be a figurehead. I think she wanted power. If y'all want me a risk officer, I should have power. And what does that power mean? Someone's doing something that's not safe, I can shut it down. That's the kind of power we're talking about. Firms like Goldman Sachs, JP Morgan, they don't like that. Those traders making $7 million a year, they don't like some chief risk officer saying, no, you can't do that. That's too risky. So read it carefully. Do they really have power, or is it entirely a figurehead kind of thing? And then you have committees. They have 3 big committees. Firm-wide, that's kind of their COM committee. Firm-wide client, firm-wide asset liability. You notice I have 2 risk management committees. Enterprise risk and ALM. To me, those are the same thing. ALM and firm-wide risk, enterprise risk, the It's the same thing. Because A, assets, liabilities, what's assets minus liability? That's the enterprise. So how's ALM risk management any different enterprise risk management? They're exactly the same. You notice what USAA said, we just said calm. We didn't say firm-wide, we said corporate asset liability committee. And then there's going to be a bunch of committees under that. I don't know if they show that in here or not. I haven't seen it yet. Here you see a big discussion. So try your best. That's why this takes some time. If you try to do this, 2 weeks before or whatever, it's just frustrating because it's a lot of text. So what you want to do is allow yourself to read it in detail and say, are they really saying something here? Is this clear? Can you tell the difference between the firm-wide new activity committee and the firm-wide operation risk and resilience committee? That's kind of cool, isn't it? The resilience committee. The risk governance committee. What's the difference between that and the firm-wide conduct committee? What are these people doing? Are there differences between them? So I love that USAA was really, really clear. Now we had a corporate ALM, and then the life insurance company had their ALM, but their ALM reported to the corporate ALM. The bank had their ALM, the ALCO, they're usually called ALCOs, asset liability committees. They reported to the column. The real estate company, the investment companies, each of them reported. So I thought we had a really, really clear process. Now, I don't know if any of y'all work at USAA today. There's a good chance that committee doesn't exist anymore. That was 4 CEOs ago. So who knows if they still do that. It was a 2-hour meeting. We had a very set agenda and we went through everything in detail, and the CEO would make decisions. I'll talk about some of the decisions he made, which were on the spot. We are not going to do that anymore. So yeah, but yeah, we're not going to do that anymore. He had that kind of power to just say, no, you're not going to do that. Pretty amazing. I doubt JP Morgan. Well, I bet Diamond would say that they would stop doing it, don't you think? Diamond says, no, you're not going to do that anymore. But if he doesn't know what they're doing, that's kind of the question. All right. So this is a big part of it, understanding their committee structure. And you do need to read through the liquidity side because liquidity is a part of that price risk. And remember, as you're reading this, you're thinking, is it measurement or is it mitigation? How did it define it? Can y'all see how they define liquidity risk? That we will be unable to fund ourselves or meet our liquidity needs in the event of a firm-specific broader industry and market liquidity stress event. So they define liquidity risk as we can't get cash when we need it. What happened to Lehman Brothers? Lehman Brothers, a lot of short-term borrowing to do longer-term stuff. Works really, really well until the bond market says we're not loaning you any more money. When you're borrowing money every single day and the market says we're not loaning you any more money, you're done. If you've seen what Morgan Stanley and Goldman Sachs have been doing, they're converting themselves from investment banks into banks, regular banks. What has Goldman been doing? They've been doing deposits, just normal CDs. They look like a normal bank now. Why? Because the deposits are wonderful. That's just cash just sitting there. So, these are the kind of things that stress out management. So Lehman Brothers, I'll show you some quotes from Lehman Brothers. Everybody went away on a Friday. The next Monday, Lehman was done for. Okay, 2008. Y'all were like 3 years old in 2008. Was anyone alive and thinking in 2008? I was 15. You were in first grade, second grade. Were y'all thinking a 2008 financial crisis? Your parents weren't like stressing out. All right, so see, I'm talking that, it's a huge part of my career, along with, y'all remember 2020 though. So we've got to go back to 2008 because it was a financial crisis and we're talking about finances. It's a much bigger event than 2020, beyond a doubt. You can't imagine what that weekend was like. I was head of equities on that weekend. It was horrible. I didn't sleep the entire last 5 months of 2008. It was a horrible time to be in finance. And my portfolio did great. And I still didn't sleep. I was sitting in bed until 2 a.m. and you just get up and go see what's going on in the Japanese market because you're just so stressed out. I was up doing option trades on my computer and emailing them to myself because I was just too stressed out. It was really, really tough. But that weekend, think about that weekend. Just amazing. We go into the weekend knowing Lehman's in a lot of trouble. the Fed gets everybody together, see someone please buy Lehman. Please, please, please. No one wants to buy Lehman. Well, why not? Lehman's got this balance sheet that is so complicated. You had 3 months, you couldn't figure it out. Do you want to buy something on a weekend where you have no idea what it's worth? Doesn't make a lot of sense. So no one wants to touch Lehman. So Lehman's going under. But then they say, well, if Lehman goes under, Merrill Lynch is going to go under. Well, someone please buy Merrill Lynch. No, we're not going to buy Merrill Lynch. No one wants Merrill Lynch. Same problem. Some of y'all have heard the story before, but boy, it's just such a big deal in 2008. No one's, if Merrill goes under, guess who goes under next? Morgan Stanley goes under. Morgan Stanley goes under. Who goes under next? Goldman goes under. We're all dead. And that's it. JP Morgan might go under next. It's just a disaster. I had a swap contract with Morgan, so I'm kind of worried about it. I had one with JP Morgan. I was like, if JP Morgan goes under, it doesn't matter because the whole world's going to end. So my boss is not going to be mad at me because we're all out of jobs anyway. And for some strange reason that no one knows, Bank of America bought Merrill Lynch for a ridiculously high price. They could have probably bought them for $15 and they bought them for $30 a share. No one, well, people think it's CEO ego. He thought, hey, I'm Bank of America, I'm going to own Merrill Lynch. They thought I was this kind of regional bank, but hey, I own Merrill Lynch. Pretty incredible. It's hard, people think 2008 was bad. It wasn't as bad as it could have been. That weekend could have been thousands of times worse. It could have been an incredible disaster. So we don't know what would have happened if Bank of America had not come in, but there would have just been topple after topple after that. This liquidity issue is what brings banks down, and liquidity is a tough one. We're talking about liquidity. It's a tough one because it's probably the hardest one of all to manage. At USAA, only way we can manage liquidity is just make sure we had sources of cash all over the place. Securities lending, debt lines in Europe, whatever, just a lot of sources. So it's a really tough one. And we'll talk about liquidity as far as where the next liquidity crisis is going to come from, right? You see stress testing log, that's a good measurement. I think what you're going to struggle with liquidity risk is the actual mitigation, because it is pretty tough to come up with mitigation on that. All right, so how, and think a little bit of process as well. What is the process? It goes from here to here to here to here. So on the who, make sure who has the real power. I do want you to talk about the board some. I think this is really critical. Because the Sarbanes-Oxley bill put a lot more pressure on the board. Boards, you need to manage your business. So look at their board and see who's on the board. These are incredibly complicated entities, very, very complicated entities. And if your board has the CEO from Coca-Cola, what does the CEO of Coca-Cola know about banking risk and swaps, interest rate risk, credit risk? Could be a really, really smart person, but that's not their field. And how often does the board meet? Like 4 times a year? I remember the board meetings we did, the board walk in, we give them notebooks this thick a week before the board meeting. There's no way they're going to know. So I think there's a big issue with boards. I used to meet with USAA board members. I remember one guy, we met with him. He wanted to come and see what we did on our side, on the investment side. And he had a really impressive resume. He had a lot of quantitative background, very mathematical. So I thought, wow, he's really going to get into this. I was going to talk about all these functions that we use to measure risk. He walks in, and as soon as we start talking, he says, oh, no, don't tell me all that stuff. I've forgotten all that stuff. I don't remember any of that. Like, you're on our board. You need to, this is what we do. You better understand this. Is not just don't bother me with that. Very smart person, but not really into what USA was doing. It's difficult. Don't you agree? That's very, very difficult to figure out what someone, I mean, can you imagine me on the board of JP Morgan? How long will it take you to figure out what JP Morgan is doing? This is a global bank, Citibank, probably the most global bank there is. They got offices everywhere. How do you know something's not going on in Singapore right now that's going to blow the whole thing up? It's tough. So think about the board, who's on the board, What's their background? What knowledge do they have? Does the CEO really give them power? I will say at USA, when Bob Davis was CEO, he demanded that the board do their job. He went to them with detailed quantitative stuff and they had to learn it. So I don't know why he did that, but that was his philosophy. Previous CEOs is like, I run this company, the board doesn't, they'll just rubber stamp what I do. But that's not what Bob Davis said. So this part, read what they have and summarize and think in those terms. Who's doing, how they doing it? What's the process? Who's got the power? How the decisions actually made? And then you're going to get into price risk. So hopefully we'll be through a few of these strategies pretty quickly here. What terms are you unfamiliar with? I've had students email me and say, JP Morgan said this, what does it mean? I've got to sometimes see it in context because JP Morgan will use terms that are not generic terms for our industry. It's their own specific term. So I have to see, some firms use economic profit, some use economic net worth. Anytime you see the word economic, and you'll see it a lot, what they're saying is, let's price everything to fair market value. Forget GAAP accounting, let's mark everything to market. So when they see economic, they're going to mark even their liabilities. It can be tough to market liability. Think about a bank savings account, like our checking account. How do you mark a checking account to market? What's the market price of your checking account at Frost Bank? It's a tough thing to do, right? What's its duration? What interest rate do you use? So it can be tough. We'll talk about that and where you can actually, depending on your assumption, you can get radically different answers. And you're going to talk about how your firm is actually managing that risk. You're going to do it. And here's your organization. Define, measure, mitigate. There's two ways you can do it. If you're going to talk interest rate risk, liquidity risk, price risk, you could define each of those first, talk about measurement of each one of those next, and then do mitigation of those. Or you could do liquidity, define, measure, mitigate, price, define, measure, mitigate. You can decide which makes more sense. That's why you need to spend some time so you can get organized, because it's going to depend on how your bank actually does it. Define's the easiest. So define, you need, definitely all of you need to have a define that quotes the bank. All right. What I have a few students doing define is they just quote something from my class notes. I don't want you to tell me how I define these risks. I want you to tell me how Goldman Sachs defines it. All right. I don't care how I define it because I already know that. How does Goldman Sachs define that? And then what does it mean to you? So it's a short section, but put some words there. Think critically. Maybe compare a couple of years. Did COVID come up? You might search on the word COVID. Is that still affecting banks? It didn't affect banks as much as obviously airlines, but it probably had some impact on them. It'd be nice to see 2022 because interest rates rose pretty sharply. That's a pretty big event for banks. Most banks like interest rates rising because they can increase their loan rates, but they can keep their checking and savings rates the same. Are any of y'all getting paid 3% on your checking account? Now you're probably getting paid 0.2% still. That's pretty cool, isn't it? Your auto loans go up to 6% and you're only paying 0.2% on your checking accounts. That's a pretty good spread. But if we go into recession, what's going to happen to banks? That's where that credit risk comes in. So there's a lot of moving parts here. All right, so this is the biggest part of your paper, is the define, measure, mitigate on market risk. And then I want a final section, and this is probably the weakest part of everybody's papers. So this is where I grade pretty tough. It's tough because you have to have an opinion on something you may not have an opinion on. So you're going to have to force yourself. So you're the CEO of JP Morgan, you walk in, is this a manageable bank? Can you actually manage JP Morgan? Is it too big? Is it too complicated? As smart as Diamond is really good background. Can he actually manage this? I'm going to show you quotes in 2008 from people like Lehman, like AIG. It's pretty amazing what their CEOs said right before their institutions went under. Incredible confidence. We have no problems whatsoever. And then 2 days later, we're insolvent. I guess maybe we did have some problems. All right, so do your best. What's your going in opinion on this? Is JP Morgan too complicated of an entity? So let's look at JP Morgan. This is, you know, when you were in first grade, this is what I was seeing. Actually, before you in first grade. So when I was in my careers in the 90s and early 2000s, I distinctly remember State Street Bank hit $100 billion in assets. I remember going, my word, there's a bank with $100 billion in assets. That's amazing. I can't believe that one bank has $100 billion in assets. What is JP Morgan's assets? Anybody know? Is it more than 100 billion, do you think? USAA has 100 billion in assets now. Any guesses? 450 billion? Higher? Well, okay, you're getting too far, but yeah, you're getting to the right area. So wow, that's actually really, did you know that was 4 trillion? You just guessed. Okay, well, 4 trillion is a really good guess. Then 3.7 trillion in assets. That's like what, a fifth of the US economy? That is 3.7 trillion all with one bank. What else do you notice? Let's look at Walmart. Walmart has $244 billion in assets and $92 billion in net worth. So what is that, like a 2.5, 1 to 2.5 to 1? What was JP Morgan? 3.7. That's like less than 10 to 1, or more than 10 to 1. These are, how much room for error do they have? If their assets drop 10%, what happens to JP Morgan? Negative net worth. They have no net worth. Is it possible for assets to drop 10%? If you're making home loans in 2008, can your assets drop 10%? Is that possible? That's pretty amazing, isn't it? It's shocking. If you told me 3.7 trillion back when I was shocked about 100 billion, it's like, I mean, the world's coming to an end. I remember USA had some bonds with Iceland banks. You know, usually governments bail out their banks. So Iceland banks started struggling. So people are going to Iceland's government saying, well, are you going to bail them out? Our banks are several times larger than our economy. We're not doing nothing. Good luck with that. We can't bail. If we wanted to, we couldn't bail them out. They're too big. They're bigger than our entire economy. So good luck with that. Could the US government bail out JP Morgan? They almost have to, wouldn't they? Something that large, can you really have JP Morgan going under? It'd be pretty amazing. Now they're the largest, but these others are not that far behind. They're Citibank. Oops. Well, we're going to talk some about that. So what does the Dodd-Frank bill say? So we'll talk some on that. Our US banks are far better capitalized now than they were prior to 2008, and they're far better capitalized probably than most of the world. But I'm saying they're well capitalized, and I just showed you it's like 11 to 1, 12 to 1. That's considered really well capitalized. But that's why you have to do the stress test. Why are you doing stress tests? The government's saying, what's the chances we will have to bail you out? So the Dodd-Frank fix the too big to fail question? Most people say no. These banks are still too big to fail. The taxpayers still probably have to bail them out. So why do taxpayers bail them out? Because of the domino effect. If Lehman goes under, Merrill goes under, Goldman goes under, you know, just this chain reaction event. And the Fed's not stepping in because they're worried about bailing out the investors of these banks. They're worried about the whole system just crashing. So it's, you know, it's that kind of thing. So Citi has 2.3 trillion in assets and 200 billion. Bank of America, not a small bank, 3.2 trillion. So these are massive organizations. And I just showed you 3 banks there where we're getting close to $10 trillion in assets with only about $600 billion in net worth. Very low. You see why we talk about ALM. You have to manage the A and the L because you have very little of A minus L. There's very little net worth. They're highly levered firms. Now, if you go to another institution, so these are banks. You notice this risk management section is going on for 20, 30, 40 pages. You go to another institution like Walmart or Target, you're not going to see a whole section on risk management. This is a major part of what these institutions do. So they have to write up a whole lot about what's going on with the bank. How well is it written? How accurate is it? Who knows? Because there's really no check on that. I'm sure the auditors read through it and try to audit it, but this is pretty complicated stuff. If you work for Pete Mark or whoever, some audit firm, you got to come in. Again, the auditors coming in, you know, they're accountants. A lot of them are entry-level accountants. This is pretty complicated stuff. Now you might say, what about the regulators? How sophisticated are the regulators, do you think? Any of y'all have family members that are bank regulators? I don't want to step on toes. So my perception, so I started at USA on the insurance side, and the insurance regulators were very unsophisticated. Didn't really understand. They were a little bit behind the times. So I said, well, it's those bank regulators, they're sophisticated ones. So then I met with bank regulators. And I started explaining what we did, and it was pretty basic finance. And the guy was like, wow, this is amazing. Never heard of this before. I was like, okay, this is stuff my undergraduate students. And I said, well, then it's the SEC regulators. They're the good ones. And then met with them, and they're like, regulators, why aren't regulators that sophisticated? Any guesses on that? You have a choice, job at JP Morgan or a job as a regulator. Which would you pick? Why? You get paid 10 times more. You get paid 150,000 a year or 2 million a year. Which would you rather have? It's tough. Unless you're going to start paying regulators $2-3 million a year, they're not going to be the most sophisticated. Now, maybe some people will be regulators because they want to save the world, but you know, you're talking a huge difference in salary. And so you're talking about the smartest, most sophisticated people in the world. They're working for these banks, and then the regulators and auditors, they're not as sophisticated because they're not getting paid as much. You can't get really sophisticated people if you're not going to pay them as much. They may be nice, smart people, but they're not going to have 2 PhDs in math and from MIT. You know, it's just not going to happen. Those people are going to go work for several $1 million. So it's tough. It's tough for the regulators to do this. It's tough for auditors to do this. There's just an imbalance in knowledge because the complications of these institutions. Yeah, Diego.
So like, how do companies like BlackRock or Vanguard relate with this?
Well, investment firms are a little bit different because investment firms are managing other people's money for the most part. Now, I know BlackRock has investments, their own investments. They have hedge funds and all that, but they are very different entities. They do have capital requirements like banks do, but they're very, very different entities. Each one's going to be different. What worries me about BlackRock is not BlackRock itself, it's what BlackRock sells. So BlackRock has a risk management tool that just is pervasive. Everybody uses it. What happens when everybody uses the same risk management tool and it has an error in it? We all crash together. So that's my fear. I'm more worried about BlackRock and the ALM software it sells than I am about its actual business. But yeah, BlackRock manages or used to manage $10 trillion in assets. I don't know what it is now. Well, there's a good round number, but it's probably a little below that now. But that's different than Bank of America. This is not assets on their balance sheet. This is assets that they're managing, other people's money. So they're not a $10 trillion business. I don't know if I looked at BlackRock on their actual assets on their balance sheet is only 153 billion. I mean, it's bigger than what I used to think was a huge bank. So it's a much different entity. And look at their capitalization, much higher, isn't it? That's more like 4 to 1, not 12 to 1. So it is a different entity. And that's why I'm not telling you to do a BlackRock, because their risk section is not going to be nearly as interesting as a JP Morgan's. All right, has anyone picked their bank already? Goldman's a popular one. Wells is interesting because of their blowups here recently. Yeah, definitely.
JP?
Yeah, JP is a pretty popular one. Morgan, Goldman, JP Morgan. So y'all see those are the most popular ones.
City.
Cities, I like City because it's so global. It's really, City's one that I worry about is just, can anyone possibly get their hands around this entity? They've got so many offices. Goldman. Okay, so is anyone that I put on my list that y'all haven't mentioned yet? Yeah, why are y'all avoiding Bank of America? Is that the boring one or? Yeah, Bank of America is interesting, I think, as well, especially since they bought Merrill. You know, that kind of gives them a interesting one. And there are others. I've had students try to do a Deutsche Bank. Deutsche Bank's interesting, especially given the struggles they're having right now. There's a lot of questions about whether or not they'll survive or not. It's not a US bank, so you don't get the same depth in their annual report. So I'd warn you, if you do one-on-ones on this list, email me and let me go look and make sure you've got, you should have at least 20, 30 pages on risk. So if you went and looked at Frost Bank, you know, there's just not much there. And Frost Bank is probably 90% on credit risk. That's the bulk of what they do. It's just not, it's not a major money center bank. No, that their risk management section of the bank is that your paper can be 2 or 100 pages. I don't give page links. You got to do whatever you need to make the case. You will have charts in your paper. So these charts, you'll definitely see them. My favorite is actually this line chart. You put the line chart in and you explain it. This is not my favorite. Bank of America has a better one, but there's some really cool charts on value risk that these banks put in that I think are really quite interesting. This chart in particular would be really interesting for 2020. This looks like a pretty healthy individual, doesn't it? If you look at their 2020, it looks like someone is having a heart attack because it's off the charts. I mean, not off because they redo the chart, but so this is really interesting chart. I like this chart, and these charts are interesting. So, right. So when should you start on paper 1? Yesterday. So you're already behind. So start working on it. I would start with just start reading, start getting the lay of the land of this. All right. So what we're going to do the next class is I have so there's no book for this class. I hate textbooks. They're grossly overpriced and poorly written, and especially risk management textbooks. If you have insomnia, y'all go buy your risk management textbook. But for this class, we're going to do interesting stuff. So don't do that. So you have my class notes. There are places you can Google terms, but you got to be real careful because some of the terms you're going to use have 6 or 7 different meanings. Value risk is pretty precise, so you can definitely Wikipedia value risk. Wikipedia does a good job on this part of it. I don't know if it does well on other things, but on value risk and stress tests, Wikipedia does a pretty good job. So if you need other reading, need any other help, you know, come to me. I can find other things. But I'm going to walk through the notes. The reason I'll walk through the notes, some students say it's too busy to go through the notes, but I'll go through the notes mainly because if I converted this all to PowerPoint, you would now have the PowerPoint and the notes and your own notes, and you've got like 3 different things. And I'd rather just have one source. So if I'm going too fast or there's too much there, you know, slow me down and we'll walk through it. But we're just going to go through the notes. We'll do a little more introduction stuff in the next class. I do have some good reading that you can do. We're going to talk through some of these. We're going to talk Bernstein first. At the end of the class, we're going to do some Taleb. We're going to do some Kahneman. We're not going to do Michael Lewis, but he talks about Kahneman. Annie Duke. I'm a big fan of Annie Duke, although I emailed her and she never replied, so maybe I don't like her that much. But anyway, I may try it again. I'm a huge fan of Doug Hubbard. I called him and he actually talked to me, so I even like him even more. But he's one of my heroes. We're going to watch one of his YouTube videos because he's just off the charts. If I had to hire someone to do risk management as a consultant, he's the one I would hire. He's just really good. And there's a few other books out there. This is actually one of my favorite books. You might say, wow, that's got to be a really boring book. Regulating Wall Street. It's about the Dodd-Frank Act. I thought it's exceptional. If I were interviewing with a Goldman or Morgan, I would read this book before my interview. Exceptionally well-written book. I found it interesting. I actually think it was interesting. I think what's funny about it is that it's shorter than the actual act they're writing about. So the act is like hundreds of pages, and this book's, you know, a few hundred pages. It's written by some New York Stern University they have some resources that I'll actually give you where you could actually put your bank into their website and see how your bank scores. So what they're doing in this book is, what does Dodd-Frank tell you? How well would it actually do? Is there a better answer? And they're going to say, yeah, we think there's a better answer. This is what they should have done. So that's the big question. If we had Dodd-Frank in 2007, with 2008 had not been quite so bad. And their argument is it probably been about just as bad. And they're going to say, if they'd done these things, they could have prevented a lot of issues. All right. So I'm reading there. So next class, we're going to start off with this right here. So any questions? I had to let you out a little early, the first class, so 9 minutes early, but any questions y'all have? Y'all can see I'm pumped. I talk really fast. If you're bored in this class, please drop it after like the third class, because this is the most exciting stuff there is in the entire history of finance. This is it. Not because of me, just because of people who taught me. We will do a seating chart on Thursday, so I can quickly do roll and learn your names. So sit where you want to sit. So today I want to do a little bit of an introductory to get you into mindset of risk management. So there's a few things. There's convention and then there's the real world. We're going to do both. So I want you thinking in terms of, that's what the textbook says. Does it really work or not? You're especially going to see it on the second project where you're going to ask, wow, does this really tell me what I'm hoping it's going to tell me? But I want to start off with this game show. I really love this game show because it's very financial. It's called Deal or No Deal. You may not have seen it. It's at the Howie Mandel show or whatever. So if you haven't heard it before, it's they're given a bunch of boxes. And for some reason, there's all these ladies with the boxes. Why they have to do that way? It seems like a really expensive way to do the program, right? Let's have 30 models and we'll pay them all to just stand there for 30 minutes. But you pick a box and that's your box. And then you slowly pick each of the boxes out there and you hope they pull what kind of numbers, that they have high numbers or low numbers. You want them to have low numbers because that means you may have a high number. Each time you open a box, the bank's going to say, hey, I'll buy you out. And the bank's going to buy you out depending on, if you open the $5 box, the bank's going to give you a really high offer. If you open the $4 million box, the bank's going to say, hey, I don't have to worry about 4 million. I can offer them a lower deal. Well, this was at one point the highest bank offer ever, $700,000. Now this is a game show and they're offering you $700,000. And these are the boxes she had left. She had these 6 boxes left: 5, 300, 10,000, 25,000, $1 million, and 4 million. So she's got a 70% chance it's $25,000 or less. And she's got a 30% or 1/3 chance that it's $1 million or more. So that sounds pretty exciting. All right. So this is a game involving money, involving risk. Sounds like finance to me, doesn't it? Money and risk. So what would you advise her to do? What does she have to do now? She has to either take the $700,000 or she has to open another box. She takes the $700,000, she's done. If she opens a box and it's 4 million, she's sad. What will the bank do then? Drop how much do you think? The 500, 400? Pretty low, right? It's $1 million, but 5, 300, she has a 1 chance in 5 of it being, over 25,000. So what would you advise her to do? Take the money, and why? So
The expected value is more than the expected value is less than the profit.
well, that's what you can ask. So what is the expected value? The median or the average is 830,000, 39,000. So that's greater than what, and the banks almost always can offer, I think always can offer less than the average, I would think. I haven't done the math, but 800,000, the median's only 17,000. So Stefan, it means, it depends on what you mean, it's greater or less. You're looking at the median, which is better, the median or the average? They should be the same if it's normally distributed. Is this normally distributed? It's pretty skewed. So, and you can tell because the average is so much larger than the median. So, but maybe that's you're saying the 700,000 is much larger than the median. She has only a 30% chance of having more than 700,000. I think this game is tricky because her decision isn't, does she open all the other 6 boxes? Her decision right now is only to open 1 box. If you told her you have to either take the $700,000 or open all the other boxes, would your decision be a little different then? Because then, you know, she only has 1 chance in 6 of having $1 million or 4, well, 2 chances in 6. So it's a little trickier. But it's Stefan, I like your answer, because usually what happens in this class, so Stefan, you kind of messed my example up, but for a good reason. Usually what happens, I get all this advice and then I have to change the question. What advice would you give her using only what you learned in your finance classes at UTSA? Because what usually happens when I ask the questions, I get all these theories that were never covered in finance. I don't hear things about expected value and median and, you know, all those kind of things. But this is a finance question and you've been taking all these finance classes. Could you advise her and only use what you learned in your finance classes? Because we don't talk like this in finance, do we? Finance is very normal distributions. Everything's predictable. We got expected values. It's a pretty skewed distribution. Is the real world more like your finance classes or more like this? That's what you have to kind of figure out, because if the world is like this and you're using normal finance, you're going to make some really, really bad decisions. What would you do if you were she? Are you tempted to open another box? So if we're going to talk about Doug Hubbard, one thing he talks about, I don't think you have it much in undergraduate, but it's the value of information. What if you had to pay some money? What's the one thing you'd want more than anything else? When I watch this program, it's the one thing I'm trying to figure out. What do you think I'm trying to figure out? Anyone curious how they got this number? Wouldn't you want to know the algorithm? What if I tell you, hey, if she opens the $4 million box, the bank offer drops to $650,000? What would you do then? Open into the box. What if I tell you it drops to 100,000? Oh, wow, that's 600,000. So the bank algorithm is pretty important. How much would you pay for that algorithm? I'd pay quite a bit. And I've had students tell me that I don't think there's an algorithm. I seriously doubt there's some employee of NBC or ABC where it is, as if they're just trading numbers. I'm pretty sure there's something going in a system that's telling him or her exactly what number to offer. I can't imagine it's anything random at all like that. I know the program make it sound like they're doing some kind of like the banks up there, you know, making decisions and all that, but I'm pretty sure they know pretty rapidly. It was pretty funny in the show. I can't remember if it was her husband or her dad. There was a debate and their family members. One was like, take the money. The other was like, go, go, go. And I think the husband would say, take the money. I think he's about to have a heart attack because everybody else is saying, you know what the audience is saying? Open a box, open a box. Now we know on these programs that they don't follow normal risk management, that people are much more aggressive on these programs than they are in real life. And so there's a chance. Now, I think she took the money, the 700,000, which is, you know, quite a bit of money. I would take 700,000 just to be on a TV show. But yeah, I like the way Stefan looked at it. I like to look at expected value. I like to look at the distribution of this. So a lot of people like to say, what's your downside risk? And you might say the downside risk is $5, but it's not. Her downside risk is $5 if you have to open all the boxes. But she only has to open 1 box. So if she opens a box and that's the 4 million and she actually has the 5, her bank offer is not going to drop to $5. It's probably going to be 100, 150, $200,000, something like that. So her worst case, but we don't know her worst case because we don't know the bank's algorithm. You can see with the bank's algorithm, I would want to know what the bank's going to offer if which of these boxes open. That would be extremely important to me, but we don't know that. I've tried to figure it out. I can't figure out exactly how they're doing it, but it is less than the expected value from the average. I like to think about ranges. I like to think, you know, 2/3 versus 1/3 kind of thing. The other thing people will say, you hear this a lot on this program, it says, hey, I came here with $0, so it doesn't matter. Is that true? Is that the right scenario? Does she have $0 right now? What does she have right now for sure? She has $700,000. So for her to say I came here with $0 is not a very smart thing to do. I don't know if she said that, but I've heard contestants say, hey, I came here with 7. That's that excessive, you know, that's the audience egging you on kind of thing. So right now, her risk-free offer is $700,000. That's for sure. And that's her starting point right now. It doesn't matter where she was 3 rounds ago. She's at 700,000. So risk-free rate is extremely important here. You always want to start with the risk-free rate. If the bank offered $900,000, if the bank does offer more than the average, I think I would take that. That seems like a pretty good deal, unless there are risk-seeking people. There are people out there saying, "Hey, I'm going for the 4 million. If I can get $4 million, yeah, I'm gonna take it." So there are people like that. What other parts of finance can you bring in here? Would it matter if she was playing this game every single day? Not just once, but every single day? Would you make a different decision then? It makes it a little tougher, right? There's one thing we know in studying behavioral finance is we make decisions in life as if it is that one decision, when in reality, we do have multiple of these decisions, but we tend to do them bad statistics one at a time versus thinking of things in a portfolio context. We'll talk about that a lot. We don't usually have decisions this extreme, but we do have a lot of decisions like this that we tend to make one at a time. And I do think, yeah, if she had to make this over and over again, she would probably make different decisions. So thinking about probabilities, and again, she only has to open one box, so that makes a difference. Yes, Stefan.
I think, it makes sense that the more she gets to run the scenario, the more likely she is to achieve the higher expected value. So it makes sense if you get to run it multiple times to do multiple dice. In poker, what they often do is, like, there's a bunch of hands on there's hands on the table, and for the last 2 cards of when people are already all in, they run it multiple times so that somebody doesn't just get screwed by the probability.
And poker is a little different than this one, right? Because she's not playing against anyone but herself.
Well, no,
But
as soon as everyone's all in, people are ready for the captain, they're like, you're playing versus the card.
Hmm.
So the scenario where you have a 50% chance of winning and the enemy has a 50% chance of winning, well, winner takes all in poker unless you run it multiple times. If you run it twice, then you are more likely to achieve your one person wins, one person wins.
yeah, I'm not a poker player. I do like the book Thinking in Bets, which is poker related. When you bring in the human factor, things do change quite dramatically if you have the human factor in poker. There's no human factor other than she's making a decision against herself. I think the world's more like this game than it is the textbooks. We're gonna look at the stock market. The stock market is usually taught in textbooks with means and standard deviations. And yet we're gonna see in 2008, we had weeks where every single day was mathematically impossible. It couldn't have happened. And yet every day of the week was that bad. So the world tends to be a little more skewed like this. I think she took the money, and then they asked her, well, what box would you have picked next? I don't know if she really knew what box she was going to pick next. She didn't have the $4 million box. So I think she was glad. I forget what box she had. I think she was glad. It's kind of thing. Did you make the right decision? But we're going to talk that with Annie Duke. One thing I love with Annie Duke is, so she says you cannot judge the quality of a decision by its outcome. And we're going to see when, she uses some examples of that. So what if she did have the $4 million box? Does that mean her taking the 700,000 was a bad decision? The quality of the decision is, what did you know at the time you made the decision? And how did you make it? That's the quality of the decision. Is there a chance she has the 4 million? Of course. But she doesn't know that at that point. Annie Duke, and we'll see it later, she uses an famous NFL game. I think it's Seattle or whoever, I can't remember who it was, but they didn't run the ball, they passed the ball, interception. People say headlines, worst call ever in history of football. What would the headlines have been if that had been a touchdown? Greatest call in the history. Does that make sense? No, it was either a good decision or a bad decision. The outcome is, if there was a 90% chance and it didn't work out, what does that mean? Well, that means there was a 10% it didn't work out. It was still a good decision. So that's what we got to do. So, but that's what this program does. It says, oh, is it a good decision or not? really what they're asking was, were you lucky or unlucky? But the decision she made was what she knew at the time. Now, I lived through 2008, so I want to tell you, it even gets more skewed than this. There's times, well, let me just show you. This movie, this is one of my favorite movies. This is Steven Spielberg's first movie. I think he made it for like $40,000. I don't know how many of y'all have seen this. You should all go watch this movie. It's a really good movie. But it's called The Duel. Have y'all seen The Duel before? Anybody here seen The Duel? Dennis Weaver, I don't know if he's still around. He has a really conventional risk issue. He's the victim of road rage. And conventional issue, so he says, conventional issue, I'm going to use conventional risk management. What do? You call the police. This trucker's been following him, so hey, I got this risk. So this is kind of 2008. Things are pretty normal. This is before Lehman. So he's going to do conventional risk management. Let's see how it works out. Didn't quite work out conventionally, did it? So the rest of this movie is, he's at this point said, this is 2008. I'm AIG, I'm Lehman, who other. What is his strategy at this point? He only has one goal at this point. Survival. That's what we don't teach in textbooks. There are times where your only goal is to survive. And when that happens, throw away the textbooks and you just start. And the rest of the movie is him in survivor mode. Y'all want to hear the end of the movie, or is that giveaway? You can clog your ears. But at the very end, he sacrifices everything but his body to win. He sacrifices his car, and he wins at the end by doing incredibly unconventional things. So that's what 2008 was like. You're off the charts. We weren't looking. None of us in September, October of 2008 were looking up textbooks. So, hey, what does the textbook say to do? Because no one knew. We were clueless. And so, interesting movie, pretty cool movie, what his final solution was. What I love about this movie, which I think Spielberg really proved himself, is you never once in the entire movie see the truck driver. The true villain in this movie is the truck itself. It's not the truck driver. Pretty cool, right? The way he did that. You never see the driver, so it's a pretty cool movie. I do recommend it. So now that I've given you the end of it away that he does survive, but you know he's going to survive. It's Dennis Weaver. So what do you do when it gets really, really rough? And so, just to warn you, sometime in your career, you're going to have a 2008. 2008 was my 2008. I was retired for 2020, so I didn't have to do 2020, fortunately. And 2020 was very different in 2008, but 2008 was late, and we talked about it last class. It's a horrible, horrible, horrible year. Do you think you will have a worse than 2008 in your careers? Or was 2008 the worst? Do you think it'd be worse? Now, so I'll just tell you, if you think you have something worse than 2008, that's going to change how you're going to manage people's money and manage your own money. Because textbooks say 2008 is impossible. It can't happen. If what you're using to manage people's money says 2008 can't happen, and you think something worse than 2008 is going to happen, then you're doing things that don't make any sense. So you're going to have to try, either can say, well, when it happens, we'll just tell our customers, sorry, things like this happen. We ruined your life. We're going to see, Caleb talks a lot about this. He's quite negative on our industry. He says it's like Russian roulette, except for we in finance, we're not holding a gun to our heads, we're holding to our client's head. We keep pulling the trigger and we say, see, nothing bad happened, keep paying us money. And whoops, sorry, these things happen. That's kind of how he says we do finance. We know we're taking risks. We know eventually it's going to be horrible, but we just tell our clients, no, this is normal, everything's fine. And then when it blows up, we say, hey, what do you expect us to do? We had no control over that. So it really is pretty material. If you think something worse than 2008 is going to happen, it should influence how you're going to manage money, manage your own money, manage your corporation. We'll talk about that, especially, I was involved in forecasting at UTSA for years and years and years. We'd forecast out 10 years and all these wonderful 10 years. And then you ask someone, what's the chance we have a recession in the next 10 years? Oh, we're definitely going to have one. Well, how many recessions did you put in your forecast? Oh, none. Okay, so you know your forecast is wrong. So why are we using this forecast? So it doesn't make any sense, but so you just admitted you think something worse than OA is going to happen. So what are you going to do about it? All right, so let's get into what is risk management. I got this definition from a fairly traditional textbook. This definition is very different than when I started my career. When I started my career in finance, I sat right next to the department called risk management. It was one guy named Jerry. That was risk management. I think today risk management at USA is over 1,000 people. So from Jerry to 1,000, how has it changed? And this definition tells you. It starts off first with the word general management function. Jerry did only one thing. He bought insurance. He was a general. He's very specific. He was the insurance buyer. So risk management has broadened out to cover everything, whether insurance covers it or not. Just every single risk in the company. It seeks to assess and address. I don't think Jerry did much of that. So what Jerry said, hey, do you have an insurance policy for it? Yes. Okay. What's the conventional? You buy this much. Okay. It was just, everything was very just, check the box kind of thing. And then here, Jerry hardly did this, causes and effects. Risk managers, when Jerry was there, really didn't try to minimize risk at the company. They just took whatever the risk was and he went and bought insurance for it. Now, after Jerry, the risk management department got to be 4, 5, 6, 7 people. And so I was next to that department. A good friend of mine, she was in that department. We called her the corporate mom because she did go out and address causes. If she saw something bad happen, she stopped it. I remember once our offices are right above the entry to USAA. And we were just looking out the window and this elderly woman gets out of her car and she trips and falls. So I'm turning to tell Ton, hey, Ton, did you see that? And wait, where did she go? And look, she's already downstairs trying to help this lady. She was sprinting down there. She got them to repay that entire entrance to USA because it was rocky and bumpy. I mean, that's power, isn't it? There's one day she was walking to her desk and these 2 guys were painting something and they didn't have a ladder. So one guy had the other one by the ankles, pulling him over the side and he was painting. She stopped that. So risk management expanded to not just buying insurance, to actually going out and just say, hey, that's dangerous, stop doing it. That's dangerous, stop doing it. And then it expanded to uncertainty risk throughout the entire organization. So it expands quite dramatically. A lot of times risk management departments weren't involved in the financial side, interest rates, stock markets, those kind of things. But now at USA with 1,000 people, they're looking at everything: catastrophes, stock markets, employment risk is a huge one, just all kinds of things. USA has had some pretty serious media risk. I don't know if y'all saw the article about the bank and their problems, and then their life insurance company had an issue. So the media relations, there's a lot of things going on now that firms have to handle. I don't understand 1,000 people. That seems ridiculously too much to me, but I don't know what they're doing. I don't know what 1,000 people are going to do 40 hours a week working on risk management. I'm sure they're doing something valuable, but hopefully. So they probably went the way too small of the department, maybe too big of the department. Maybe it should be somewhere in between those two. But you're going to notice this in your banks that risk management is essentially the umbrella above the entire corporation. It's one thing you might want to do on your bank, which I haven't had too much luck with this, but there's one bank I think that does this, but I'm sure they all. Go to your bank's mission statement, not for risk, but for the overall bank. So, and just see, what do y'all think? Do you think JP Morgan mentions risk in their mission statement? Well, let's start off. Should JP Morgan have the word risk in their mission statement? I would think so, because that's kind of my thing, but do you think they do? So let's see if they actually. We aim to be the most respected financial service firm in the world, serving corporations in more than 100 countries. What are their values? In a fast-moving, increasing complex global economy, our success depends on high faithfully. We adhere his accord, delivering great service, acting with integrity and responsibility. No word risk yet. How much further down do you have to go? There's 5 keys. So You might just search on the word risk and see when's the first time it comes up in your annual report. That might be interesting. But I do know there is at least one of the banks that you are covering that does mention risk in its mission statement. Security, achieving high, rapidly increasing sales, investments. I mean, it says security for depositors. That's kind of implies it, but check and see. If I were running a major money center bank, risk would be in my mission statement, and to manage risk, because you say something like this, achieving high and rapidly increasing growth rates. Fast growth can often be very risky. So, they say we want a lot of growth. Yeah, you want a lot of growth, you just misprice your products, you get a lot of customers, and then it all blows up on you. So you would hope Wells Fargo would have the word risk in theirs, given what their history here. We want to satisfy our customers' financial needs and help them succeed. This unites us around a simple premise. Customers can be better served when they have a relationship with a trusted. Well, they added that to their mission statement. That's probably important. That knows them well, provide reliable guidance, and can serve their full range of financial needs. Still, there's nothing in there about risk, but at least one of you has it. I just can't remember which one. Now, when you do risk management, your goal is not risk minimization. That's pretty easy. You can minimize risk at United Airlines by just stop flying planes. That's pretty easy thing to do, but it kind of destroys your business. So your goal is what we call risk optimization. So if you're taking risk, you want to be well paid for it. If you have a risk you're not well paid for, you want to find some ways to mitigate it and get it off the table. So you always want to be paid for taking. This is a phrase you want to somehow work in your interviews. You want to be paid for taking risk. It's extremely central to finance. So risk optimizations, regulators, rating agencies, they want risk minimization. You can't. There are many institutions that their risk framework is whatever the regulators say or whatever the rating agencies say. You can't do that. We kind of got stuck with that at USAA because we want to be AAA. And the rating agencies say, well, you better do this. And we say, well, I guess we got to do that because we want to be AAA. You don't want them dictating your company because you may be walking away from great opportunities. So here's the process. Bottom line, the process is to find, measure, mitigate, but we can break it out a little bit more. So the first thing you got to do for risk management is you got to figure out why you exist. That's why I went to the mission statement of these organizations. So you might put the mission statement and just ask the question, does it imply risk management at all? Some of these mission statements look like they're somewhat geared to the retail customer, not to the corporate side. So maybe they have a mission statement that's more geared, obviously JP Morgan, Goldman, they do a lot of corporate banking. So maybe they have other mission statements. But why do they exist? Really, really important, because you look at AIG went under doing something that had nothing to do with their mission statement. They created this department. A few people took on these massive risks, brought the entire entity down. The rest of the organization, incredibly sophisticated, very smart, very good risk managers, but it didn't matter. This one small department destroyed everything. So, what are you doing? What's your purpose? Why are you trying to exist? This is true on the individual level as well. If your goal is to have a 3,000 square foot house with a picket fence, a spouse and 2.5 kids and a dog or whatever, and that's your goal in a certain amount of time, what are you doing that's going to disrupt that? That's not helping you get to that you can eliminate. If you're sky jumping every Friday, that may not be helping you get to that goal or whatever. So you have to ask, what are you trying to accomplish in life? What could derail that? If there's things that derail that aren't that important to you, stop doing them. Once you figure out why it exists, then you do the measurement part. And the measurement part has a few pieces to it. Risk identification. So in risk identification, you're trying to identify perils and exposures. So a peril can be something external and can be something internal. So something external could be interest rates. Interest rates change and that negatively hits your company. It could be the stock market. It could be a fire. Some forest is on fire. That's external. A peril can be internal. It could be an employee. An employee does something that gives you bad press. You think about Société Générale in France, they had an employee who decided to do all these fraudulent transactions just to bring the bank down. It wasn't like he was defrauding the bank to make money. He did it just because he didn't like the bank and just to bring, he was like a hero in France because French were like, yeah, take the big guys down. But he wasn't doing it to rob the bank. He was just doing it to try to mess them up. That was an employee that was a peril because he was trying to mess it up. Sometimes you can be both a peril and an exposure. So an employee on the job that's not following the rules and gets injured, they're both the peril and they're the thing, they're the asset that's injured. And so we'll talk about some universes of risk here in a second, but a lot of firms will have a universal risk. I don't know if your banks do, you might try that. They don't always publish that, not universal risk. So they may not publish it. They probably do internally. At USA, when I left, they had like 100 things listed on universal of risk, and it made no sense to me. They had things on their list that I thought were a little bit not the right kind of things. And one of the things they had in universal risk as a peril was their net worth. When's the last time your net worth attacked you? If you remember, you were sleeping, you know, playing mind your business, and your net worth walks in, starts beating you. Doesn't happen. What is net worth? That's an exposure. They had net worth. Now, I agree, net worth going down is a terrible thing, but why did it go down? It doesn't just go down on its own. It's go down because the stock market fell, interest rates rose, whatever. So I didn't quite like their list. I think they sat around just thinking too much and just started throwing things onto the list. But a universal risk, I'll show you my favorite universe of risk because it's one of my favorite firms. And then you got to do, sometimes it's pretty obvious, pretty easy, sometimes a little more complicated, but risk analysis. How does that peril interact with the exposure to cause you a loss? Obviously, it's an employee. Let's say you have a rag on the floor, an employee walks by, slips on the rag, gets injured. Okay, so the rag is the peril, the employee is the exposure. Pretty obvious how that fits together. Now, let's say you're Microsoft and oil prices go to $200. Is oil prices a peril? It is. Does it affect Microsoft? Well, that's what you have to kind of think through. What if oil prices shot up suddenly? Does that affect Southwest Airlines? They hedge oil prices, so it might actually help them if other airlines don't. You know, those kind of things you have to think about. What about Valero? Oil prices go up. Does that affect Valero? So it affects different groups different ways. So that's what you're trying to assess. I love to ask hedge funds, what happens if oil prices go to 200? What if the VIX goes to 80? What if interest rates go to 10%? Just to see what they say, partly just to see if they've thought about that, if they run it through their models to see what happens if this goes on. Most of them will know the VIX, but they may not know oil prices. So you ask those questions. So the worst thing is you have a peril that's going to affect one of your exposures that you've never thought through. You've never gone through that analysis to see what could happen. So this really is, we got pretty crazy at USA. We're trying to find correlation. My boss, he said, what if a hurricane comes across the ocean and it's carrying some plague and it gets us all sick? And I'm thinking, I don't think a virus can survive a hurricane across the ocean. But he was being creative and kind of thinking through it. So I say, okay, that's probably a little too much of a stretch. All right, and then risk measurement will be in terms of frequency and severity. So we have a statistic of the probability of something happening, and then when it happens, what's the severity? That's what value at risk is. Value at risk is an assessment of frequency and assessment of severity. So value at risk says, hey, 1% of the time we expect to lose $500 million or more. That's a value at risk. Severity and frequency in there together. So which is easier to calculate? Kind of depends on the risk. At USAA, the biggest risk was hurricanes. What's the probability of a hurricane? We have a lot of history, but obviously people are talking about ocean waters being warmer. What is that going to do to a hurricane? What's the severity? Well, that they can do pretty easily because they know the address of every single person they're insuring. They can run models and say, this hurricane hits here, this is how much we lose. And those models are fairly accurate. They're not perfect, but they're fairly accurate. So the probability is the hard one because that's the one that's probably changing more unreliably. So there's the measurement piece. Then you start the mitigation piece. And mitigation piece has two pieces. One of them is internal to the firm. And then the other one is you go outside the firm for help. So internally, you're going to do risk control. Risk avoidance, risk prevention, and risk reduction. Risk avoidance is when you just say, let's eliminate the risk entirely. That's what AIG should have done with that credit default swap department. Now, y'all, some of y'all have John Tui. Have y'all talked about AIG yet? You should have one class where you just talk AIG because it'd be a really fun session to have. He didn't work in that department, but he certainly has, you know, everybody at AIG knew what's going on. So you can sometimes do risk avoidance. United Airlines cannot practice risk avoidance for a plane crash. That's just core to their business, so they have to do it. So if it's core to your business, you're stuck with it. But if it's not core to your business, you probably shouldn't take that risk at all unless you're just getting really, really well compensated for it. Risk prevention is you're focusing on frequency. You're trying to bring the frequency down. Risk reduction, you're focused on severity. So prevention is before anything's happening, you're trying to reduce that probability. That would be like you have a pool in your backyard, you're worried that the neighbor's kid's going to drown in it, so you put a huge fence around the pool. And that keeps the kid out, hopefully. I've seen some of the videos that people have those, and the 2-year-old toddler just jumps right over that thing. And, you know, you see the dad jump from the second floor into the pool kind of thing. So you still have the risk, but hopefully you reduce the probability of it. Risk reduction, the risk has already happened, but now that it's happened, you're going to try to reduce it some. So maybe you learn CPR or something. Now, a lot of times prevention and reduction contradict each other. So a good example, I'm a biker, but I'm not a really great biker, but I bike all the time. So it's kind of embarrassing. I bike all the time when I'm not really good at it. But I used to do mountain biking. I finally stopped because I had too many accidents. I remember talking to a student once and I hit a bump and I just went flying, and my phone, I could hear him, Professor Sweet, here. But on mountain biking, there's this saying that faster is safer. Now, what are they really saying? Safer in what terms? Frequency or severity? If you go faster on a mountain bike, are you reducing frequency or reducing severity? Frequency, yeah. If you go fast on a mountain bike, you don't crash as many times because you just kind of fly through things. So frequency comes down. What does severity do? Goes up quite a bit. So I hear that faster is safer, and I go as slowly as, like, you know, I feel it. Because I'm on blood thinners. You know, if I crash, my doctor says you crash, you die. I say, okay, well, I'll try not to crash then. I wear out brakes really fast on my bikes, but I see the point. Faster is safer because you have fewer accidents, but when you have the accident, it's going to be pretty serious. So a lot of times reducing frequency increases severity, reducing severity increases frequency. You have to somewhat play the two together, but your expected loss is the multiplication of the two. So it is somewhat of a mathematical formula. You're trying to reduce the combination of the two. So you can look at those two together and see, but it's not always linear. So maybe you can reduce your frequency from 2% to 0.1%, but your severity goes up from 1 billion to 12 billion. You know, those kind of things you have to worry about. So you do as much as this as you can. You have policies, you train your employees, those kind of things, to do as much as you can. I know working with TON, anytime, like I know they had an employee had a heart attack. You know, that's a terrible thing, but happened at the job. That doesn't necessarily mean USAA responsible for his heart attack. He could say, you know, stress related, but her focus was, this is risk reduction. Her focus was on what did USAA do once we learned the guy was having a heart attack. Who showed up first? Who called? Did a nurse come? What did the nurse do? How long did it take for the ambulance to get there? Who called the ambulance? When the ambulance arrived on campus, how quickly do we get them in? That's what she was asking. So the next time she could make sure, you know, if someone has a heart attack, we're going to reduce that risk as much. Mainly, you know, you obviously want to save the employee. You also want to make sure that you're not creating losses unnecessarily. And then once you've done everything you can do, that's when you're going to turn to someone outside. And that's when you do risk financing, risk transfer. A lot of people think risk transfer is risk avoidance, but it's not. You buying auto insurance from State Farm is not risk avoidance. You still have the risk, but you're just, State Farm's going to step in and pay for it. The reason you haven't eliminated risk is because if you have a car accident and you call State Farm with the claim and State Farm's gone insolvent, you still have that risk. Risk avoidance is there's no way, you can have a loss. So risk financing, and you're hiring somebody else to help compensate you when that happens. And there's a whole range here. It can be just purchase auto insurance, life insurance, those kind of things. It can be even be captive insurance companies. Captive insurance companies is you own a subsidiary and they are your insurance company. Doesn't sound like much risk transfer, does it? Because you're paying yourself. So that to me, the main thing for that is tax benefits. Risk securitization does transfer risk. Letters of credit, they transfer risk in a sense that you can get cash when you need it. You have to pay it back because you're borrowing money, but it does prevent some of that risk. But we'll be talking some of these. I include interest rate swaps in this category, so we'll be talking interest rate risk. I include stock options. We'll be talking about stock options. I consider them in that category. So there are, and in fact, your banks are going to be doing a lot of this they're going to be doing swaps and futures. I just assure you they're going to do swaps and futures. And if you don't think they are, search on those words, swaps and futures. They may not do a lot of forwards, but they're definitely going to do swaps and futures. Probably in the billions of dollars range. And then at the very end, you retain what you retain. Risk retention at the end. Is that a bad thing? Well, if you're getting paid for it, it's not a bad thing. Eventually, a bank's going to have to take risks, aren't they? There's going to have to be something residual there. Or why do you exist? Same thing with you personally. I mean, premature death is a risk. You can buy life insurance, but life insurance doesn't reduce the frequency of premature death. It just gives you family money. So there's risk you're kind of stuck with. You can reduce the frequency of premature death by not jumping out of planes with parachutes on your back and those kind of things. But there's a limit to how much you can really get rid of entirely. All right. So one of my favorite firms, Capital Market Advisors, I might have their website linked. Let's see if no, I don't. Let's see if I can find their website. They keep changing their website, so I'm not always sure I can find it. Leslie Rawls, see if she's still there or not. This comes up. So USA did a project where we're going to hire a consultant. And we had 5 or 6 firms, and they were all in New York. So went and visited them. Tillinghouse, Ernst & Young, I forget, just a bunch of them. And this was one of the firms we visited. All the firms were really interesting until we got to this firm. When we walked into this firm, I was so intimidated. I just did not say it. You ever been in a place like, if I don't say anything, they won't know how little I know. So I'm just going to sit there. You shake your head, right? Like, I don't know what you're saying. I have no clue what you just said. So that's the way I felt in this firm, and it's not coming up. But Leslie Rawl started this firm with, I forget, Barbara something was the name. They were both there. We got to meet them. Just brilliant people. If you want to know who this firm is, even though they may not be good with websites, this is the firm that when Lehman goes under, this is the firm they call to figure out how to fix everything. Lehman is a very complicated firm. And when they go under, you call this firm and say, hey, they've got some complicated assets and liabilities and contracts. We need someone to sit down and figure out all the pieces. This is the firm that they call. Same thing with AIG. Extremely impressive firm. I think the lady Barbara, I think she retired, but I think Leslie Rawl is still there. I'm going to try it again. See if another page will come up. I want to show you their website because it's a really cool website. So if we could ever get into their website, is it just that the host system's down, or is it just them? Looks like it's just them. Something's got to work. There's Leslie Rawl right there. Maybe we can get her bio. Yeah, they're frozen. I'll email them, let them know. I tried to advertise them. They probably won't hire you. I don't think they hire finance majors. If you're an actuarial major, they might. They tend to hire engineers and math majors. So that's why, when you're getting your master's, You can get an MS in finance, but you might want to get a master's in mathematics or applied mathematics or econometrics or something to give you those math skills, or at least the programming skills. So that's the kind of people they're hiring. So here's the universal risk that they use. It's somewhat tongue in cheek in a few places, but it's also a legitimate one. So legal risk we'll talk about. That's definitely one of us. We're not going to talk about political risk, but that's certainly one. We're going to talk a lot about ALM mismatch. She has the limit up there. Limit to me is not a peril, it's a mitigation, but I think she means something different there. Prepayment risk we won't talk about too much, but it's certainly there. That's the risk that people pay off their mortgage early because interest rates are low and you end up getting your money back at the worst possible time. Equity risk, we're going to talk about that. So that's pretty obvious. We're going to talk about liquidity risk. That's fairly straightforward. We're going to talk about basis risk. Anybody know what basis risk is? We're going to do a case study on basis risk. So you know what a basis point is. It's not related to that, but basis risk is the risk that you buy something. I'm going to show you a huge basis risk we have with our pension plan. You buy something as a hedge. So you say, hey, if this falls 20%, we want something that's up 20%. And then this falls 20% and this is only up 7%. That's basis risk. You tell your boss, hey, we're hedged, don't worry about it. It crashes 20%, you're only up 7%. You tell your boss, well, I thought we were hedged, but we weren't quite hedged. That's not a good thing to do. What I'm going to show you at USA went the exact opposite. We hedged something and what we hedged actually went down, and our hedge should have gone down, but it actually went up, went in the opposite direction. So kind of cool, right? That's the kind of thing you're hoping for. And if they ask you, say, yeah, that's what we plan to do. You have to make it up. Haircut risk, we won't talk about haircut risk. That sounds like a strange one. But haircut risk, anybody have a guess on that? Some of you are probably thinking, yeah, I've had some haircut risk, but no, it's not, has nothing to do with your hair. Any guesses on haircut risk? So a haircut is, you say, okay, we bought this bond yielding 6.7%. We're gonna pay our customer 4%, so we're gonna keep 2.7%. We really only need 2.5%, but we're gonna keep an extra 0.2% to cover us for credit risk. That 2.2% is your haircut. Haircut risk is that 0.2% wasn't enough because you went into a major recession or something like that. So that's what haircut risk is. Daylight risk, I think President Biden just discovered daylight risk with his Corvette and other documents. That's daylight risk. Something hits the press and you don't really like stuff hitting the press. Personnel is a big one. We'll talk some of that. Netting, you're going to make sure in your paper you talk about master netting arrangements. It's an extremely important mitigation technique. You got to make sure, just explain it out because you're going to see this. You might not think it's a big deal, but it's a huge deal. So let's say you have 7 contracts with Exxon, 7 different contracts, and Exxon goes insolvent. And 5 of those contracts, Exxon owes you money, and 2 of those contracts you owe Exxon money. Well, Exxon creditors say, well, we're not going to pay you those 5 contracts because we don't have any money, but you need to pay us the 2. You're like, well, that's not fair. We got 7 contracts. The 2 that we owe you money on is 100 million, but the 5 you owe us money on, it's 500 million. It doesn't make sense for you not to pay us the 500. We have to pay you the 100. And netting, what it says is, all of the contracts we have, they're all netted into one contract. So if you go insolvent, we only owe you the net. All right. So you'll see these master netting arrangements to make sure, because they do dozens and dozens of contracts with the same entities. So it's pretty important. Contract risk we'll talk about. Reputational risk we'll kind of talk about a little bit. Mark to model risk we might talk some about. Accounting risk we'll talk about. Concentration risk we'll talk about. There's some in here I'm not exactly sure what they mean, but do y'all see any that are relevant risk? We're going to talk about that. I'm not real sure what they mean by. You may know what over-representation means. I'm real sure on that one. Currency risk we'll talk about. Longevity risk we're going to talk about. Contagion risk we'll talk about. So yeah, we'll talk about probably most of these. Suitability, we'll probably talk a little bit about that. Yeah, it's interesting. They have a timeline of risk. And it's pretty hilarious because they go over time and the major risk in any year. It's just kind of bouncing around. And then 2008 hits and it just they run out of room. And 2008, each individual risk in 2008 was bigger than all the previous ones combined. And then there's a bunch of them in 2008. So it's just 2008 was just a crazy great year. But there's a universal risk. I wish I could show you, some of your companies. You might type the word universe into your bank's annual report. I don't know why they would use the word universe other than universal risks. You might try that and see. I doubt they would give you that list because it might be really, really proprietary, but you might look through it and just see. But the list we're going to use comes from the group of 30. This is the term I couldn't remember from last time. So the G30, you probably heard of them. So this is their risk, their list. Interest rate risk, liquidity risk. Remember, interest rate risk is a special case, a price risk, but interest rates are so critically important. We separate that out as a separate risk. Credit risk, basis risk, modeling risk, legal risk, disclosure risk. There's your accounting side, the tax risk, operational risk, which is kind of a catch-all, inflation risk, and then currency risk. So we'll go through each one of these. We're going to spend the bulk of our time on interest rate risk and market risk. Those are the two where we have the most to say. And your paper is really going to focus in on these first three. I used to do credit risk, but it's just way too much, and it's a lot of just cumbersome stuff that you don't really learn much from. So I took that out of the paper. All right. Comments on that? Do you have a universal risk for your own personal life? What would be your universal risk for your personal life? There's some obvious ones, aren't they? Remember Jerry? What did Jerry do? He bought insurance. What do you buy insurance for? Car. So car is what? Property risk and liability risk. So there's some property coverage in there. Life insurance, so premature death. You can't really buy insurance for life. You can buy insurance in case you die early, because mortality, everybody's mortality, as far as we know, is 100%.
Yes.
Now I know Elon Musk, we are working on the fountain, but even the people that are working on the fountain of youth, they're talking about us living to 150, not the 3,000. So we're all going to die. So we're talking about premature death. We're not saying, wow, what happens if I die at 105? That's not premature death. What is that called? Y'all saw it in my life insurance class last semester. What's that called? Do you think that's a risk, living too long? Huh? Outliving your income. What other risks do you have? Is disability a risk? Are you going to buy insurance for that? Probably not, because your employer will probably provide it to you. Disability and illness. What about unemployment? Is that a risk that you get fired or your company goes insolvent or lays off people? That's certainly a risk. You have other liability, don't you? You probably don't buy any insurance for that. What if you're playing football at the park and you throw a pass and you break your friend's leg? You got to pay for that. You're liable. You have some coverage for that. We didn't put it up here. What other coverage do you have? Someone probably mentioned it. Well, health, we can certainly put that, but that's part of disability, but separate. What? Oh yeah, homeowners. So that also includes property and liability. So you do get some coverage there. So if you broke your friend's nose or foot in a football game, your homeowner's insurance would cover that. But I bet a lot of people in this room don't have any renters or homeowners insurance. And you're kind of like, I'm a college student, sue me. You're going to spend more money suing me than I even have. So, you know, good luck with that. So you're probably okay with that. What about investment risk? Any of y'all have investment portfolios? Maybe a little bit. Yeah. When you turn 40, 50, then that becomes a much bigger issue, you would think. You know, so you have a lot of these. Insurance covers a lot of these personal risks. My guess is none of you buying insurance for that one. We'll talk about that. What is a 50-year-old who owns a $500,000 house and has a $500,000 stock portfolio buy home insurance without even thinking about it, but doesn't buy any insurance for their stock portfolio, even though the stock portfolio is much more likely to crumble than the house is? We'll talk about that. Is it a pricing issue? Is it availability issue? You can buy insurance on a stock portfolio. It's pretty easy to do. It's called an option. And in fact, what's the price of an option called? Well, but the price of the option, you buy an option, you pay the option premium. What is your auto insurance or homeowners insurance price called? Premium, right? It's the same thing. Homeowners auto insurance, those are options. If you don't like the price of your car, you sell it back to the insurance company at the strike price, which is, you know, the replacement value, or not, well, the actual cash value. So you have those kind of risk. We're going to talk about these when we talk about pension plans, because you have the same risk as a pension plan. We're going to talk about how the pension plans should be managed, and maybe you should be managing these risks in a very similar way. So you have a balance sheet that has these risks, some on the asset side, some on the liability side. How are you going to manage all of these? And should you manage as a portfolio or individually? Well, we'll ask that one. I don't think that's how you spell should. So should you think about it? So I remember one of the problems we had was we were running the risk for a bank, a life insurance company, a property casualty company. We're talking about how to hedge these risks. And one thing that became really obvious is when the life insurance company was really doing badly, the bank was doing great. And when the bank was struggling, the life insurance company was doing great. And it's like, you know what? We got our hedge. Those two offset each other. One loves rates rising, one hates rates rising, one loves rates falling, one hates, you know, it was just a perfect hedge. Why buy insurance if you're already hedged? So, and there's another case where our CEO was so scared interest rates are going to rise, so he started shortening our exposure. He started exposing us to rates falling, and I had to bring up our pension plan. I said, you realize I have a pension plan that if rates fall, that thing's going to go up hundreds of millions of dollars. So he was actually increasing our risk. We were doing the absolute worst. So I had to bring the pension plan into our analysis so that he could see, yeah, you're actually you're more exposed to rates falling than you are to rates rising, because we weren't looking in that context. So you may actually hedge a risk, which you already have naturally hedged. And so when you hedge it, you're actually increasing your risk, because you're kind of doubling down on the opposite side of that. So, so a universal risk can be a personal thing. You can certainly look at it from that standpoint and then manage it in an intelligent way. So, all right. So before we get into these risks, I want to give you a little bit of the history of risk to show you those conventional ways of looking at risk. And there's a great book out there by Peter Bernstein. Oh, I should have brought it tonight. Against the Gods. Again, batteries. No, I don't want that. So Against the Gods by Peter Bernstein. Maybe I'll bring it next class. Not very expensive. This is what textbooks should cost, because this is as good as any textbook you've ever had. But he goes through the whole history of risk. There's a really, he was a great writer. Unfortunately, he passed away. Really great writer. He doesn't write technically. So someone who has no background in finance could read this book and really get a lot out of it. And at the same time, someone with a heavy finance background can read it and get a lot out of it. That's pretty good writing, isn't it? You can hit both the technical and non-technical side. So really impressive. What I love about this book is I went to a conference and I wasn't even paying attention who was at the conference. It was an actual conference, and I show up and Peter Bernstein is the keynote speaker. I had no idea. It wasn't a big conference. There's only like 20 of us in the room. And I was reading his book. So I go, hey, Mr. Bernstein, I've I didn't know you were here and I got your book. So will you sign it? I was like, so that, and he goes, yeah, whatever. You know, but he did sign it. You can barely read what he wrote, but he did sign it. He's written a few other books, you know, really good writer. But this is by far his best. So I want to review what he said were those most important discoveries in risk management. His book goes a lot more than what I'm just going to hit kind of the high topics. He has a book on gold that I have not read yet. And I don't know if how good that one is. But and he has one other, I can't remember. I think he has an updated, he has a book called Capital Ideas, which is the history of finance. So this is the history of risk, which has a lot of finance in it. And then the history of finance, things like Markowitz and William Sharp and Fama and all that kind of stuff, Black-Scholes. All right. So let's start one of them. Let's see how many of these that you know. So let's just start with that. Statistical inference. Anybody can define that one? You did that in your stats class, didn't you? What's a one-sentence definition of statistical inference? You've probably done it a lot. So you need an N. What is your N? Little n. In order to try to figure out the big N. So your little n is the sample size. What is your big N? Your population. You remember statistical inference? You're going to take a sample size and try to figure out what? The characteristics of a population. All right. Is statistical inference important to risk management? You're trying to figure out how risky is the stock market. You take a sample. What's your sample? History. What are you somewhat implying that history gives you a good evidence for the future? Maybe or maybe not. We'll see. The next one is law of large numbers. Y'all remember that one? So law of large numbers means the larger your sample size, the more likely you are to get the population correctly. Law of large numbers. There's actually one theory, one of the Bernoulli brothers says, hey, if you get a large enough sample size, there's no risk. That may be true if you're looking like average height of men. If you sample size every single man in the world, you'll probably get a pretty good idea of the distribution of men in the world. But again, in finance, you know, one key thing you learn in your stats class, your samples should be drawn from the population. Isn't that true? You shouldn't draw your sample from enough, but we're using history to predict the future. When your sample is history, how much of your sample is coming from your population? Your population's the future. We already have a really serious problem, don't we? We're sampling history, trying to predict the future. We're assuming history somewhat looks like the future, so that works. Reversion to the mean, we'll talk about that quite a bit in the class. So see at the end. So what reversion to mean says is when something gets well above its average, it's more likely to be below average going forward than above average going forward. I'm a big believer in better on reversion to the mean. I talked at a conference. Hopefully they were listening to me because they would have gotten it just right. I said, where are some good reversion to the means? And one of them was the US dollar. You look at the US dollar, when it shoots up the way it did, it usually shoots down. So great time to buy non-US stocks because you can get a 20-30% return just from the currency appreciation or just buy currencies. But the US dollar is already weakened 10%, so it's too late now, maybe, or maybe not. Another one is the value versus growth. I talked about that in investment society. Value stocks are unusually cheap versus growth stocks. That's a reversion to the mean. So what you're looking for, which is a big philosophy of mine, is you go out into the world and you look at relationships and you're trying to find two things that are like 3 standard deviations away from their normal relationship, thinking they'll come back together. That's the reversion to the mean play. That makes a lot of sense. We're going to spend a lot of time talking about correlation and diversification. In fact, a major exam question. In fact, it's interesting. I was asked to speak to a conference here in a couple of weeks, and I gave them 5 topics, and this is the one they want. The question: does diversification work? So we're going to have that question: does diversification work? It's the #1 risk tool in finance. You're going to see it in your banks. Diversification, but does it actually work? So what I'm looking for here is the definition of it. What is each one of these? How do we apply them in finance? And then when do they mess us up? We make really bad decisions because we over rely on them. And that's kind of my case. You're going to see I'm going to y'all could probably get me fired, take that lecture and show it to Dr. Baina and say, you won't believe what he's teaching us, but I do want to somewhat get you, as you graduate, get you a little bit uncomfortable to start thinking, wow, I got to start questioning, because they're going to love that in interviews. Say, yeah, I learned this in my stats class and my finance class, but I've started thinking about how well that really works. If we need to maybe have a new theory, they're going to love that. They want innovative, curious people. So I'm going to somewhat question a very basic convention of diversification. Can we really rely on diversification? And then if we can't, what are the alternatives? So I just leave y'all out there hanging with nothing to fall back on. I'll give you three backups to diversity. I've already mentioned two of them. I already mentioned two of them that you can have for diversification. So we're going to go through these, give you a little bit of a history of them. So that we'll do that next class. So any questions anybody has? I'll start doing attendance so I can start learning y'all's names. Everybody's good? All right, so what should you be working on right now is paper one. Paper one is very difficult. Spread it out because you're going to need time. You're going to be reading really difficult jargon. You don't want to be reading 20 pages at a time. You want to be able to sink into one page and really get into it. All right, so start now and make it a pleasant exercise.